Well, what's the monetary degradation? You go look at an M2 chart, and you go back to 1980, how much money was in circulation, M2 monetary, measure. And in 2011, and compare that to where monetary growth is now compared to those time periods. How much is the money supply doubled, tripled. And if silver were to simply match the growth of the decay in the value of the money, or the increase in supply of the money, it'd be $300 to $500.
Veteran technical analyst Michael Oliver asserted that a breakout in the price of silver would likely be explosive, with prices potentially surpassing $200 per ounce sooner than anticipated, or even reaching $500. Mr. Oliver argued that silver's market structure has undergone a fundamental shift. He noted that corrections spanning several months are no longer observed. Instead, they are now measured in days. And to be frank, he expects silver to reach a minimum of approximately $200, adding that he would not be at all surprised to see it approach the $500 mark. Recently, silver has experienced significant volatility, retracing nearly 16% of its all-time highs before rebounding to reclaim those levels over the course of just 10 trading sessions. According to Michael Oliver, silver will cross $500 per ounce in the worst-case scenario. Before we move forward, if you want to stay up to date on the latest gold and silver news, you can subscribe to our channel and like this video. Now, let's get back to Michael Oliver's view on gold, silver, and the overall global economy.
The stock market breaks, especially the financial sector. Fed doesn't care about AI, but they care about the banks, okay, and the credit card companies and, et cetera, the financial sector. And if that starts to show vulnerability, and technically we see that, our opinion is S&P's not made its high yet. Okay, now how do we factor that in and be bearish? I think it'll be a desperate last spike high. And I bet during that time, you won't see the financials do the same thing. So in effect, you get the same type of divergence you had in 2007, which was a big tap on the shoulder. Hey, something's wrong here. Okay. But the Fed will be acutely aware of that. And that's what drives the monetary metals, the degradation in the money unit. And I don't mean to just mean here. Then there's another market factor, not just the stock market's going down. Bonds, government debt paper, not mortgages like in 2007 to 9. They've not been influenced by lower rate cuts in 90-day T-bills or something. It doesn't influence them at all. Long-term yields have stayed glued to a ceiling at very high levels. And we watch 30-year T-bond futures. Well, we know there's been a bond crisis in Japan, and they've got the same problem we do, except theirs is now more forefront. And their new prime minister, what's her name? But she is like the Trump of Japan and declared herself to be that. She says, we're going to print. I love it. You had a supposed free market president or prime minister there saying we're going to print. Oh, great. Have no respect for the value of money. Okay. And Trump wants to print. And I think we've been topping effectively in the S&P since last year this time. We're at 6,200 then in February, just short of 6,200. Right now we're trading 6,700. Oh, big deal. Okay. But it's still a topping process from our vantage point. I think that once it shows that it was topping and alarms people, where are they going to put their money? It's never the case. You go back to history. 29 to 32, 73 to 74 in the stock market, 2000, 2002, 2007 to 2009. Stock market collapses. Did gold collapse? No. There's always an alternative to the stock market, and usually it's the monetary metals. Oh, they'll have zigzags in sync with the stock market here and there, but their trend can be totally opposite. And I think that's what it's about to occur.
Oliver, who made his debut in the futures market in April 1975 and subsequently developed his own methodology, structural momentum analysis, MSA, has maintained that the current movement of monetary metals does not constitute an ordinary bull market. In his view, the customary overbought rules so familiar to investors, as well as the classic reflexes regarding profit-taking, are precisely the mechanisms by which investors are shaken out of the market, just before the true acceleration begins. His central argument is simple. Momentum tends to signal a breakout in advance, rather than focusing solely on price. Oliver transforms price data into a momentum-type oscillator which measures the deviation. either upward or downward, of the price relative to a moving average. He asserts that this momentum structures generates their own levels of support, floors, resistance, ceilings, and trend lines. Moreover, significant trend reversals often manifest at this level even before becoming evident on price charts. Oliver used gold as a common thread to substantiate his general thesis. Most observers underestimate the magnitude of the percentage moves that monetary metals can achieve. He cited as a reference gold's corrective low in 1976 around 100, as well as its 1980 peak near 850, a rise he characterized as an approximate eightfold increase in value. Next, he highlighted the bull market of the 2001-2011 period, which also generated the rise of approximately 8 times, culminating in gold's 2011 peak of around $1,920. In light of these historical comparisons, Oliver argued that the current cycle, initiated from the bear market low of $1,050, has to date yielded an increase of only about 4 times its value. If gold were merely to replicate historical gains by a factor of 8, he suggested that the benchmark price would hover around $8,500. He implied that the current macroeconomic environment could justify an even more pronounced advance, but he used the $8,000 to $8,500 range to refute the notion that gold is currently overvalued or that it has already reached its peak. Oliver argued that silver is no longer constrained by the old range of $40 to $50 that framed the market for approximately half a century. He indicated that in the coming months he expects silver to reach a few $100s, with a realistic possibility of it settling between $300 and $500. Furthermore, he asserted that the historical ranges of the silver to gold ratio, situated between 3.1% and 6.5%, could be challenged or even surpassed. His argument was as follows. Even if gold were merely to climb toward $8,000, these proportional relationships would imply price levels for silver that would astonish those investors who sell simply because the chart appears to indicate an overbought condition. Physical silver is evolving into one of the most unique configurations we have observed in decades. And according to Mike Maloney, the real story lies not in price movements, but rather in the structural forces brewing behind the scenes. Meanwhile, the gold to silver ratio continues to decline, a sign that silver is gaining strength relative to gold. Mike's long-term chart shows that this ratio has fallen below the 65 mark, whereas normal historical levels used to hover between 33 and 35 during eras when global reserves were abundant. Institutional investors are beginning to build massive positions. In some cases, they are even contemplating acquisitions in the $100 million range. This phenomenon typically occurs right at the onset of a metals cycle, before demand from retail investors experiences a sudden surge. That's all for today. Let us know your views in the comment section below, and don't forget to like this video before leaving.